The dollar is under pressure, and most people do not notice it. Banks are selling massive amounts of USD to fund physical metal holdings, and this is happening right now. Statements look normal, and screens update in real time, but the reality is different. The system is shifting beneath the surface. Dollars are leaving banks faster than ever. These sales are not speculative. They are required by regulations. Banks must hold physical gold and silver to comply with Basel III and NSFR rules. Paper contracts are no longer enough. Every unallocated account becomes a liability. When rules force action, dollars are the easiest asset to move. Selling dollars raises liquidity for acquiring physical metal. This is not rumor. It is happening in real time. Central banks are aware and observing. The Fed knows liquidity is being drained. Banks cannot ignore capital requirements. They cannot rely on paper promises. Compliance means converting dollars into tangible assets. The effect is immediate. Currency supply tightens. The value of the dollar weakens. Foreign reserves face pressure. Traders notice spreads widening. Markets see increasing volatility. The retail public remains mostly unaware. Statements and balances provide false comfort. Behind the scenes, banks act to secure assets that meet regulatory standards. Physical gold and silver are now Tier 1 assets. This forces institutions to prioritize them over paper claims. Unlocated accounts no longer satisfy requirements. Banks convert liabilities into tangible metal. Dollars leave accounts to fund these purchases. That is why we see sudden USD drains. Dollar liquidity contracts systemically, so the mechanics are simple. Banks sell dollars, fund metal purchases, and adjust balance sheets to comply. The implications are enormous. Dollar-denominated assets come under pressure. Exchange rates react. Treasury yields adjust. Those relying on unallocated accounts face hidden risk. Physical possession is now the anchor of safety. Paper promises are temporary. Retail investors may discover liquidity constraints unexpectedly. Timing has become everything. Banks move first. Regulators enforce quietly. Markets react later. USD drains precede visible price changes. This is not panic. It is mechanical. Each dollar sold to fund metal increases scarcity for the next transaction. It triggers a chain reaction. Physical metal hoarding accelerates. Acquisition rates surpass most observers' expectations. Banks act with foresight. Retail markets lag. Paper contracts face exposure. Statements mislead. Screens mislead. Only physical ownership guarantees control. This process is global. The East has been ahead. Shanghai Gold Exchange operates fully allocated. The West is now catching up. Banks scramble to comply. Treasury operations, swaps, and FX desks coordinate moves. Dollars sell quietly to avoid market shock. But the total volume leaving accounts is unprecedented. Short-term liquidity spikes mask long-term drainage. Overall, USD supply is redirected to fund metal purchases. This has ripple effects. Hedge funds relying on USD leverage face higher costs. Treasury-backed securities adjust. Currency pairs shift. The system recalibrates. Actions are legal and enforceable. The retail public sees delays. Physical scarcity comes before price spikes. Holding actual metal gain. Paper holders face constraints. Dollar drains reduce liquidity for trading. This tightens credit for derivatives. Short covering rallies may occur, but retail access is limited. Institutions act first. Regulators follow. The public reacts last. Timing determines advantage. Rules have changed. Banks act. Physical metal purchases are mandatory. Paper dollars are liquidated to fund holdings. USD weakness is now an enforced outcome. Inflationary pressure rises. Currency purchasing power declines. The shift favors tangible assets. Compliance comes first. Banks hedge against risk. Paper holders compete for leftovers. Patterns repeat across jurisdictions. Unlocated exposure is a liability. Retail investors at the bottom face the consequences. Statements mislead. Real-time screens deceive. Only possession guarantees control. Timing, awareness, and physical ownership are the only advantages. Dollar sales accelerate metal accumulation. Every move is necessary. The hierarchy is enforced. Retail investors must understand logic. Timing and preparation are everything. Physical metal is the anchor. Paper reliance is a liability. The system is active. Alerts are live. Dollar sales happen continuously. Metal holdings rise. The shift is irreversible. Awareness preserves value. Delays risk losses. Timing defines advantage. Physical possession ensures security. The hierarchy has shifted. Compliance drives actions. Markets follow slowly. USD drainage continues. The alert is real. Physical metal is essential. Paper cannot replace it. Timing, access, and ownership determine outcomes. The system is acting. The rules are live. The USD collapse is underway. Those who understand can act. Those who ignore may face forced liquidation. Compliance and hierarchy dictate outcomes. Physical possession now defines safety. Paper dollars lag. Awareness is essential. The system is enforcing change. The era of relying solely on unallocated accounts is over. Physical control is now king. Dollar sales fund the required holdings. The shift is active. The alert is immediate. Prepare now before access is restricted. Physical possession guarantees survival. Paper cannot ensure security. Timing and preparation are everything. The USD is draining. Physical metal is increasing. The hierarchy determines winners. The system acts. The alert is real.